Good morning. Welcome to Stock Market Today. It's Tuesday, November 13th, 2018, a rainy Tuesday here in New York. I am your host, Dan Russo, the Chief Market Strategist at Cnx Analytics. Follow me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Cnx Analytics in conjunction with StockCharts.com and Stock Charts TV. A special thanks to the team at Stock Charts for hosting this show in the 9:15 slot every day. So diving right in now, U.S. equities were lower in Monday's trading with the major markets down nearly 2% or more. Technology was the big decliner on fears surrounding Apple demand, a lot of impact on their suppliers as well. Defensives were the best performers with REITs, the only sector to finish higher. The Treasury market was closed for the Veterans Day holiday. The dollar continued to strengthen, dollar index touching its highest level since mid-June. Dollar was still weaker, however, on the risk-sensitive yen cross. Yen tends to strengthen in a risk-off type environment that we had yesterday. Gold finished down 40 basis points, and oil ended down for an 11th consecutive session. WTI settled lower by 40 basis points. And as we get to the desk this morning, futures are up 60 basis points after the U.S. equity market sold off sharply yesterday. Asian markets were mostly weaker overnight, though China did extend recent gains. European markets are mostly higher as we speak. Treasuries are stronger across the curve after being closed yesterday for the Veterans Day holiday, and the dollar is firmer against the yen, but lagging on the euro and sterling. Gold down 20 bips, and WTI crude adding to the pain. It is down over 2% here this morning. And as we look at the major market, here it is. I mean, you can see what looks to be a defined range coming into play here. We're back below the 200-day moving average, which is still declining. Support is in the 2680 to 2700 zone, kind of right around in this range here. I don't want to crowd the chart with too many lines. It becomes hard to see. So we have the first support zone at around 2700. Resistance comes into play in an area that surrounds the 200-day moving average. 2750 to 2770 is kind of this 20-point range that contains the 200-day moving average. And then up here in this kind of 2810 to 2813 range from which we failed last week. Remember, we closed there on Wednesday, tried to trade above it on Thursday and couldn't, sold off Friday, sold off yesterday. For you pattern traders, it's not lost on me that a lot of people like to trade patterns, and you're probably seeing the setup. It does look like a potential head and shoulders, but I always caution for people who trade patterns, you have to let the pattern develop. Anticipating patterns could be a very easy way to lose money quickly. You want to let the pattern develop. If you're going to trade a head and shoulders here, you want to see a rally begin from this level that breaks above the neckline, and then that would confirm that the pattern is complete. The RSI remains in bearish ranges here, actually turning lower once again. Chaikin money flow has turned bullish. We'll see if we can hold on to that bullish level. So the two main indicators that we look at are still flashing mixed signals, which I guess kind of confirms this range-bound trade that we've seen here for the past couple of weeks. We'll see how it resolves. Right now, I think the best course of action is still to favor your defensives and your low beta names for long exposure. Turning now to your market in a minute. Every day we send out an email and we highlight the kind of 5 key points that I'm talking about in my note to Chaikin clients. You can sign up for that email. Head over to chaikinanalytics.com/today. So S&P 500 moves below the 200-day moving average again. We chatted on that already. Concerns about Apple weigh on the tech sector. And remember last week we were talking about tech, and you've heard me say we're at an inflection point for technology relative to the broader market. Well, for the time being, it looks like the bears have the upper hand. We'll take a look at what that means. Defensive sectors continue to outperform. Healthcare breaks to 2-year relative highs. Remember, healthcare has been a group that we've been very bullish on, and that strategy has paid off. Futures pointing to a higher open. As we come now to the power bars for the major indices, we can see for the Dow down 2.25% yesterday. 4 bullish or very bullish stocks, 4 bearish or very bearish stocks. There's the S&P 500 down nearly 2%, 64 bulls to 82 bears. Tech and high growth healthcare weighed on the NASDAQ yesterday. It was down nearly 3%, 2.94%, 11 bullish or very bullish stocks, 18 bearish or very bearish stocks. Small caps an inline performer. down about in line with the S&P 500, 193 bulls, 470 bears. And according to the Chaikin Power Bar, small cap stocks were more bearish than large cap stocks, and the major indexes are mixed. Turning now to our stock of the day. If you're following along at home, if you've caught that email, our stock of the day, generated based on our proprietary Chaikin Power Gauge rating, is Cnx Resources. Comes to us from the Oil Exploration and Production Industry Group. CNX closed at 15.25 yesterday, down 1.99%, so a slight underperformer. Stock has a very bullish power gauge rating due to very strong price volume activity, attractive financial metrics, and a positive expert activity. However, it does have weak earnings performance. So what do we have here? Let's run through the analysis. Very bullish stock, strong trend, but a weak industry group. Very bullish rating, but the dynamic duo not yet in gear. Market and model not yet in agreement. Bulls can take solace in the fact that the intensity of the underperformance has been lessening of late, but we are still underperforming relative to the SPY. Money flow trying to turn positive. Stock has regained the long-term trend line, which has shifted from declining to flat. Stock kind of consolidating here, but it is overbought based on our overbought, oversold indicator. And just the weakness in oil is really going to weigh on sentiment for these E&P companies. That's exploration and production. So while I think it's a good idea to have a list of very bullish E&P names to potentially look at when the tide turns, I don't necessarily like getting involved here, just given the headwinds from oil, number one. And number two, the stock is overbought and it's not yet outperforming the market. Add CNX to a bullish watch list, but I don't think it pays to get involved here and now. Turning now to our sector tracker, let's look at the movement of the major sectors over the last 5 days. And you can see as the S&P 500 has faded from that resistance level that we cited, the defensive groups are shining once again. Real estate up over 2%, healthcare up nearly 2%, utilities 1.25%, and staples. Utilities 1.75% and staples 1.25%. And energy, there's that energy underperformance, which is why I don't want to go necessarily and get aggressive on energy names at the moment. Down over 2.3% last few days. Comm services down over 2%. Tech just under pressure. We're going to take a look at that a little further now and then a little bit later in the presentation. Middle of the road, discretionary industrials and financials. Our industry in focus today comes to us from that tech sector. And it's interesting because software and services was a group that we were and had been high on for a while, but we don't remain dogmatic in our views. When the facts change, we change our mind, and the facts have changed here for software and services. Over the past 6 months, the group has underperformed the S&P 500 by 40 basis points, 39 basis points, but its power bar, which measures future potential, is weak. 35 bearish or very bearish stocks for only 14 bullish or very bullish stocks. Group is currently ranked number 8 of the 21 subsectors that we look at. And some of the indicative names there that are very bearish are Coupa Software, C-O-U-P, Blackline Inc., ticker BL, and Nutanix, NTNX. All have very bearish Chaikin Power Gauge ratings. And let's dive in on Nutanix here a little bit because I think there's a pretty compelling setup for a bearish trade. Very bearish stock, weak trend, weak industry group. So we're fishing in the right pond if we're looking for bearish ideas. If you're long Nutanix, I think you have to reevaluate why you're long and whether it makes sense to stay long. So reading up from the bottom of the chart, here's the ribbon at the bottom of the screen, power gauge rating on that bearish or very bearish rating since mid-August. Stock been underperforming the market since the end of August. Dynamic duo in gear, market in agreement with our model. Stock is currently overbought. This little rally here produced some bullish money flow, but money flow has been predominantly bearish since the mid to late August timeframe. Nutanix is below the falling long-term trend line, which is now lining up with price-based resistance here in the $48 to $50 level. So I think the setup looks pretty compelling for a bearish trade here in Nutanix, ticker symbol NTNX, especially if you get a rally back towards, kind of this 40, towards the top of yesterday's bar. I think if we can rally back towards the top of yesterday's bar in the $42.5, $43 level, it makes sense to open a trade to the bearish side in ticker symbol Nutanix. Looking at yesterday's S&P 500 gainers and losers, NKTR was down hard on Friday, and then they presented some data over the weekend that seemed to soothe some investors' concerns. Excuse me. That stock rallied 8.75%. NRG, just a stock that's on the 52-week high list. That stock up nearly 4% yesterday. ConAgra up 2.5%. CAG catching the benefit of the flight to safety in consumer staples. Perrigo was down hard on Friday, saw a little bit of a rebound yesterday, up 2.36%, but it did catch a downgrade here this morning. FE, neutrally rated stock, up 2% yesterday, also a member of the 52-week high list. We talked yesterday a little bit about the utilities that were levered to California, PCG and EIX, seeing some follow through from what's going on in California with the fires there. Again, if you're listening in California, if you have friends and family in California, number one priority is I hope that you, your family, and your loved ones are safe. But that's really if you're wondering what's going on with some of these utility names that are exposed there, that really seems to be the story. Abiomed down 16.6% as they presented some data over the weekend that did not sit well with investors. AMD down hard yesterday, down 9.5%, following a cautious note from a sell-side research shop. Remember, we looked at AMD yesterday as a bearish idea, so that theme playing out. And Align down nearly 8%. No real news driving that other than to say that Align is one of those kind of high-growth, high-valuation stocks within healthcare that's seeing some profit-taking from investors. Turning now to our earnings update, ACM, neutrally rated stock, beat by 2 cents, and UGI is a very bullish stock. They beat by 13 cents. Reporting today, before the open, all neutrally rated stocks, AAP and Home Depot both reported. Their stocks are trading mildly higher here this morning. See if that can help out the struggling consumer discretionary group. Tyson, TSN, one of the food stocks, so that would be within consumer staples. They report before the open this morning. Did not see much pre-market activity there. Nothing really important to speak of after the close from what we can see. So turning now, it's Tuesday. I look at relative strength. I look at sector rotation. I think it's very important to look at how sectors are trading on a relative basis to get an idea on where you want to go looking for long and short ideas. And last week we talked about tech. We said it was at an inflection point as it was testing support at the 200-day moving average, as well as price-based support. Well, further weakness over the past week has driven the group below the 200-day moving average and below that price-based support. So here we're looking at tech, XLK, relative to the broader market, and you can see what looks to be a topping formation taking place. The RSI of the ratio putting in a series of lower highs as the RSI appears to be shifting to bearish ranges. And here's a 2-year uptrend line for tech on an absolute basis in the process of breaking down. We want to see the tech sector start to form a base and stabilize and move higher because it is 20% of the S&P 500. Right now, weakness seems to be in control. The bears have the upper hand for the time being. The onus is on the bulls to reestablish the uptrend. Here's that relative breakout, though, in healthcare that I've been talking about. Healthcare seems to be playing on some of the defensive properties, or investors are playing on the defensive properties. Here's the XLV relative to SPY, breaking above to a 2-year high. And look at the RSI has shifted into bullish ranges, and we're still remaining a nice uptrend on an absolute basis within healthcare. It's the services names, and it's a lot of the big pharma names that are driving outperformance there, while biotech continues to underperform. And here's utilities now on the verge of an absolute breakout. Here we're looking at absolute price of the XLU on the verge of a breakout above the 200-day moving average. Bullish shake in money flow, and XLU relative to the SPY breakout, test of support, and now moving higher in textbook fashion. Investors continue to favor the defensive groups. That is the main takeaway of my sector rotation note today. So sign up for that email, chaikinanalytics.com/TV, to follow along with this show and get free stock ideas and help us spread the word. Share our link on social media. See you tomorrow, folks.